These cigarettes cost me $5 every single day. Do you know how much that is across 10 years? That's right around $18,000. Literally gone up in smoke. If I just parked that money in a drawer, I'd still have $18,000 to this day. But if I would have invested the same $5 every single day into the S&P 500, today it would be around $30,000. That's a $12,000 opportunity cost for one tiny habit. In the next few minutes, I'll show you why every single dollar you invest multiplies just like this, and the idiot-proof auto-invest strategy I used so future me never burns money like this again. That $12,000 gap is why every dollar you invest early multiplies. Let's break down the math, and I'll show you the autopilot setup that makes sure future me never burns cash like this again. First, let's start with the why. Why does this matter? Well, to get into this, first we need to talk about inflation. Inflation is the reason why every year your groceries get more expensive, your gas bill gets more expensive, your phone bill gets more expensive. It's not that those items are more valuable in itself. The value of the dollar goes down every year. The buying power of the dollar goes down every year. So what you could buy with $10 today, in a couple years, you wouldn't be able to buy with $10. It would be the equivalent of, let's say, 15. That is inflation. Inflation goes up every year by right around 2 to 3% in a normal economy. Now, in recent years, and especially since the pandemic, things have gotten way worse with this. You may have noticed all the prices surged up to ridiculous levels. Some countries even reporting 10 to 15% per year inflation, which is absolute madness. So how do you beat this? So let's take a $10,000 example for this. Let's say you save up and you have $10,000 in a drawer. Okay, and it's just sitting there. But even the 2% inflation value per year, those $10,000 in right around 30 years, they're going to be half that. Or rather, they're going to value at half that. You still have 10,000. The number of money obviously doesn't change. No one's taking it away from you. But what you could buy with $10,000 today, in 30 years, you will only be able to buy the equivalent of 5,000. So what can you do really about this? Well, most people keep their money in a savings account, right? That gives you a little bit of interest over time. The good savings account can possibly give you 3 to 4%, which is great, don't get me wrong. As long as it beats inflation, that is all you can really hope for from a savings account. But what if I told you there's a better way to keep your money? Okay, so in my mind, there's 3 things you can do with the $10,000. You can put it in a drawer, let it sit. You can put it in a high yield or decently high yield savings account and let it go up like that. Or you could invest the money. Well, in this video, I'm going to talk about why investing the money and the savings account are the 2 obvious choices you should make for this. So let's take the same $10,000 example. Let's say you have $10,000, put it in a drawer. In 30 years, still $10,000. Nothing changed, it's still there. Possibly dusty, but it's the same money. If you put it in a savings account, on the other hand, in 30 years, you'd have roughly $24,000 saved up in there. Which is not bad. You gained $14,000, just great, good for you. But if we take into calculation inflation, those $24,000 will value pretty much same as the $10,000 did 30 years ago. Right? Imagine 2% every year, it's lost to inflation. It's got to count for something, right? You can't really ignore that. So what about the third option? What about investing the money? Well, with investing, you have slightly better options. Particularly, the interest rates are better. The average return of the stock market over the history of it is right around 10 to 11%. My favorite stock to invest in is actually a conglomeration of multiple stocks, and that is called an ETF. That is the S&P 500. That is the perfect balance between safe and with a decent upside. So if we take the S&P 500 for this example, and we take the 10% every year, not adjusted to inflation, of course. In the same 30 years, from the same $10,000, assuming a 10% interest, you would get $228,000. Now that's a big difference, isn't it? Now why is that? Well, it's the magic of compound interest that is at play. If I'm not mistaken, Einstein named this the 8th wonder of the world. It's just math. It's gonna be boring, but trust me. it's worth doing. So let's say you take the 10,000. In a year, you have a 10% return on that money, which makes it 11,000 by the end of the year. You have gained $1,000 for that 10% of yours. Now, what about next year? Well, the next year, you will not be getting another 1,000 because now you have 11,000 in the bank, 10% of which is $1,100. And the next year, just the same, and the year after that, just the same, and keep doing this for 30 years, and you get to astronomical numbers, like 224,000 I just mentioned. Now, another advantage of this is the passive nature of it. This is probably the one true way to actually achieve passive income. I don't really believe any source of income is truly passive. Everything has a cost to it, whether it's time or it's an investment. But this is the closest you're ever going to get to actual passive income. You just take your money, you put it in an investment fund, and you just let it grow. And in time, it will grow. So if you like the idea of making money while you sleep, this is probably the best way. And I urge everyone to try it. It is super simple to get into, and there's absolutely no barrier to entry. And due to the nature of compound interest, the most important thing you can do is invest early. A man smarter than I once said, the best time to invest in the stock market is 10 years ago. The next best time to invest in the stock market is today. Now, I know this might be a scary subject for some of you. I understand this can be intimidating and it can seem like a lot. You need to follow the progress of the company and try to understand stocks and try to understand the market. There's people that study their whole lives to be able to do this. But what if I told you things aren't really that complicated? They just seem complicated. And when in fact, it's just as simple as setting up an account and putting it to AutoInvest. There's nothing complicated about it. And in this video today, I intend to show you exactly how I do it and how you can do it as well. So you can secure yourself a better future. So let's go over some common myths that are associated with investing in the stock market. Number one, you need a lot of money to start. No, you don't. All you need is $5. Do you have $5? I'm betting you do. If you put $5 today, $5 tomorrow, $5 the day after that, or maybe, I don't know, maybe you can afford that. Maybe you can just do it once a week. $5 this week, $5 next week. That is an absolutely acceptable start. The most important thing is starting. You don't need $10,000 to start this journey. You don't need to buy an entire stock. You can buy something called fractional stocks. You can own a small part of a stock. Yes, one stock might be thousands of dollars, but you can own 1% of that. It's not a problem. Modern platforms like Trading212, eToro, Interactive Brokers, to name a few, they give you the opportunity to buy fractional shares. You don't need to have the entire thing. Literally any amount of money, maybe there's a minimum sign up. You need to go in like $10, but that's at most. But you don't really need any starting capital. The capital is going to be there in time if you keep investing. Number two, too risky. Well, obviously, with every investment, there's risk. You cannot guarantee the direction. Nobody, absolutely nobody alive can know what the stock market will do tomorrow.
Number one rule of Wall Street. Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles.
This is why it is very important to shift your mindset a bit about this, about investing. Investing is not a way to earn money quick. You shouldn't buy cheap, wait for it to go up, and then sell expensive, and boom, you've made a lot of money. No, that is not how most people should do this. That is called day trading, and that is a complicated subject for very specific people to do. I might do another video on that at a later time, but for now, let's stick to the basics. There is risk involved. Of course there is, and there always will be. But if you average it out over 30 years, take your time, the risk is almost nil. Here you can see a graph of the S&P 500's behavior over the past 30 years. As you can see, there are points where it's down and there are points where it's up. But overall, the trend is a nice upward curve, and that is what you want to see. You don't want spikes. You don't want things to go up too fast or too slow. If things go up too fast, they may be overvalued and they will go back down. And if things go down too fast, they might be undervalued and they more than likely will go back up. And here is why the S&P 500 is my favorite one for these types of things, because it is safe. The S&P 500 spreads your money, spreads your $5 you just put in there, spreads it across the top 500 US companies that exist today. And that list changes all the time. But your money is still invested in the top 500. While investing in specifically Google has the chance to blow up in your face, because you never know what Google might do, what scandal can arise, or what bad idea they can have and the stock would go down, or what brilliant idea they may have and the stock may explode. You never know how that will work out. But if it's spread across 500 top US companies, the likelihood is, on average, it will go up. And you can see that. The S&P 500 has been around for almost 100 years. And while it has had higher years and lower years, on average, it is always an uptrend over long periods of time. Number 3, I don't have time to invest. I understand time constraints might be a problem for you. While I do have the time to sit and read and look into all of these and make very informed decisions about what I do, I can understand that for most people that is not possible. You have other jobs, maybe you have kids, maybe you have other businesses, side hustles, what have you, and that is okay. You do not need time to read into this. You need to simplify. I urge anyone, especially if they don't really have time, to go with ETFs. ETFs are funds just like the S&P 500 I just talked about, but there's more of them. There's top 100, there's top 100 in tech, there's top 100 in production. It's basically a conglomerate of stocks all taken together, and you invest in all of them at the same time. Those tend to perform decently well. Sure, you will not see insane numbers. You will not see the S&P 500 going 5,000% in 2 years like we saw Nvidia recently. But you have the stability. And with stability comes the confidence that you can just let it ride, let it roll, let it auto-invest every single day, every single week, every single month. And at the end, when you want it, your money will be there. In 30 years, in 20 years, in 10 years, whatever your goal is, your money will have multiplied. Number 4, you should wait for the best time to start doing this. The best time is now. Yes, I know some people try to time the market, and that is fair enough, right? It makes sense to look for when the market is low and buy in at that point to maximize your gains. But if you think about it, over the course of 30 years, will this 2% really make a difference? Well, no. Especially if you keep putting it up. Just start. Go ahead. Go right in. Dive today. So let me show you exactly how I do this. Let's step to the computer and I'll explain this to you step by step. The first thing, you want to open an account, right? I already have one open, so I shall log in. But once you've completed all the steps and processed all your documents and everything that you need for taxation purposes and whatnot, you will end up here. Now, this is a paper account, FYI. Please ignore the numbers. It's just some money they gave me to try out, just for explanation purposes. Let me show you how you can set up an auto invest really quick. So you have these instruments, and here you have a new pie. You click that. Make sure it's set to custom and set to add instruments. If you want to go into the S&P 500, which I highly recommend, you need to type here USA. If you want something different from this, feel free. There's other options. You can pick a single stock. You can pick whatever you like. Personally, I prefer this. Click next. Now, let's break this down for a minute. So here you can see 14.18%. That is the average return for the past 5 years for this particular stock. It's not necessarily going to be the same in the future. As I said, the average is around 10 to 11% across its entire history, but well, if it's 14%, all the better, right? Next, select Auto Invest, hit next, and here you can see the projections. These projections are pretty cool to look at. Let's play around with this a little bit. So if you did have a $10,000 investment, and let's say you never invested again and did this set this to 30 years, with a 14% interest rate, that's $700,000. Just like that. It's never touched again. Just put it there one day and remember it when you're old. But possibly more realistically, let's skip the initial deposit. Let's just put the minimum of 10. Well, for me, it's euros. For you, it might be dollars or whatever currency you function in, but I'm from Europe, so we'll go with euros here. So if you do 10 euros, in 1 year, you will have accumulated 131 euros with a monthly investment of 10 euros. if you go and let's do this daily, as I personally recommend, if you're able to and if you can afford to, you will have the $3,92000 at the end of the year, which is pretty good as far as putting money aside goes. That's a significant amount of money, I'm sure, for many people. Now, let's take a look at this graph. This is split into two parts. If you can see, there's two lines. There's this gray line and then there's this blue line. Now, what's in between here, that little area? That is the money you have gained from interest. And what's under the gray line is the money you have actually put in yourself during this time. And here you can actually see after 1 year and 3.65 thousand contributed, this will be your final number. The difference between the two being what you have gained from interest. It's not very impressive in 1 year, but if we take this further, let's go to 10 years, for example, it's already starting to look pretty good. So you will have $80,000 in here, which is really good already. But you will only have invested 36,000. Okay? So all of this blue area here, which is already bigger than the gray area, is your compound interest. You will have earned more money from compound interest than you will have put in. So you've already doubled your investment in just 10 years. This was no matter how much money you put in. You can put 50,000 euros daily and you'll have stupid amounts of money, but the ratios are still the same. Let's go to 20 years. In 20 years, the difference is very obvious now. With only $73,000 invested, you will have $400,000 in your account. So the vast majority of your money now comes from compound interest. And if we go a bit further, I like the 30 years. With 10 euros a day, an initial deposit of 10 euros, you can get to 1.8 million, which is already really good. Most people can probably retire with that in 90% of the 90% of the planet. And if, let's say, maybe you're really, really young, maybe you're 20, maybe you're 18, maybe you're a teenager, and you can afford to do this, your parents can give you money to do this, or you have a good job early on, you can even push this to 40, which is unrealistic for most of us, because well, you might want to take your money out before you actually get too old to spend it. But if you go 40 years, this becomes just insane. You will have invested 146,000 and gained 7.5 million. This works very well even with lower numbers. Let's say you can only invest 10 euros a week. You're young, you're 18 years old, you barely make any money. You'll still be a millionaire by the time you're 60 with 10 euros a week. That's what, 2 beers in most of the Western world? I'm pretty confident most people can sacrifice that for, being a millionaire eventually. And of course, if your income grows, you can step it up 50 euros a week, maybe 100 euros a week if you start earning really well. Some people can actually afford that, and the numbers just go up really fast in this way. But let's stick to the basics. 30 years, even if we do a weekly, it's pretty decent. I would say maybe a bit more a week. Maybe you can only do 5 euros a day. So that's 35 for the whole week. No problem. You're almost a millionaire regardless in just 30 years. Now, I realize this is slow, and I realize this is probably not most people hope for, and this is not a get rich quick way. This is what they call get rich slow. This is something you should be doing on the back end. Leave it there, and you quite frankly forget about it as much as you can until the time has passed. And if you keep at it, you will get there at some point. What's your next? You just name it. Let's say VUSA daily. You can make as many of these as you want, so you can spread them around. You can do whatever here. Click next, and here is your final call. You click Fund Pi. It will automatically take it from the money you already have in Trading 212. But if your account is not funded, this will automatically charge your credit card, the one you have linked to your Trading 212 account. Fund Pi. Of course, autopilot really exists because this is probably the fourth take of this video, but this is the entire process. Now let's get back. So is this the only way I use to make my money? Well, no, it's not. I understand some of you might not be particularly happy with just a 10% return per year. Give me a subscribe. Watch out for the next videos, and I'll show you how I maximize that to get every single penny out of the stock market as I can. There's quite a few tips and tricks I can share with you. Let me help you learn how to invest in your future self. Let me help you understand how this works, and let me show you my exact blueprint, exactly what I do, step by step for free on my YouTube channel. All you need to do, hit the subscribe button. I'll see you here next week with the next steps. If you take a look at the description, you will see a link to the 22on2 website, as well as a link to a site that calculates your compound interest over time, where you can input your numbers, how much you want to invest every day, and where this will get you. And please feel free to check out my other videos. Here's a video of how I got laid off. That should be interesting. Thank you for watching this video. Have a good day.